All right, let's get started. I got the thumbs up from Will, which is always good. He has, again, put the camera in a very strange angle. So I'll try to keep looking forward and not stare off into the corner like last time. So my name is Mark Lamonica. I'm the product manager for Morningstar Premium, morningstar.com.au. And today we are going to talk about portfolio construction, which is exciting. But before the exciting part, we have to go through all of our housekeeping items. So anything you hear today is general advice. I don't know anything about you, so I can't offer you personal advice. Also, for those who tuned in last time, New Zealand has come up with a new verbal warning that I need to read. So get ready for this. Views expressed in the presentation are of Morningstar and not any individual, which I guess would mean me. Any advice is general in nature and that attendees should seek advice of a financial advisor if they require tailored advice to their situation. And along with the great content, research, and tools on our website, you can also find the New Zealand disclosure statement. So go on and read that. And the peanut gallery is laughing already, but that's okay. The other housekeeping item is I would love questions. So there's a Q&A button on your Zoom screen. So please ask any questions, ask them at any time. I can hit them as we go along or get to them at the end. You can also confuse me by putting them into the chat, which is very exciting for everyone. All right, so let's get started. So today we're gonna do a lot of screen switching. For those who have attended these things before, no, it is not my strong suit. But let's do this anyway. All right, so we're gonna talk about goals-based portfolio construction. So before we get into this, I want to talk a little bit about putting together a portfolio, which is obviously the topic of today. We'll walk through a couple real examples. But first, I want to talk a little bit about Morningstar's philosophy on how to construct a portfolio. So we've got this saying at Morningstar that I always say, and so my teammates sometimes roll their eyes when I say this, but we are about the investor and not the investment. So the whole meaning behind that is that your portfolio is supposed to accomplish a goal. We are not doing this for a living. We are trying to reach a goal, whatever that may be, and the goals are unique to you, but we are trying to accomplish that goal by saving and investing money. So that is why we want to start with your goals, as opposed to a lot of people in the industry that start with the actual investments. So you walk into some financial advisors and they're really happy to tell you about the ETF they think is great for you to buy, and they focus on products. But we're going to get to products last. We'll start with you. And that's the whole point of this process. The other thing that I wanted to talk about before we get into this, and hopefully this will become evident why we're doing this, is traditionally how people put together portfolios, particularly some financial advisors, is they will start off by looking at your risk tolerance. So there is a risk tolerance questionnaire, is something that is used a lot in the industry, and there are all sorts of things wrong with the risk tolerance questionnaire. In fact, at Morningstar, we think, most things about a risk tolerance questionnaire are wrong. So here are the problems. And what a risk tolerance questionnaire is you go in there, you talk about how much risk you're willing to take on, and then you get spit out a risk tolerance at the end of this, and then you design a portfolio that is based on that risk tolerance. Well, that is, of course, nonsense, because when we are investing, it is not how much risk we are willing to take on. It is what risk do we have to take on to actually achieve our goals. Will's pressing a button on his camera, which makes me nervous, unless he's turning it off. But so we're going to talk about how much risk you should take to achieve your goals, because that's the whole point in investing. And the risk in investing, in our view at Morningstar, is not volatility. So it's not how much your portfolio bounces around on the way to your goal. It's instead, are you actually going to achieve your goal? And risk tolerance questionnaires do not get you there, because they are starting with this assumption about how much risk you are willing to take on without putting your goals into, without taking your goals into account. The other thing that's wrong, that's terrible about a risk questionnaire, is nobody fills them out accurately. So there's been study after study after study, and showing that these things aren't accurate. And the reason that they're not accurate is because you are being asked to assess how you would react to a hypothetical situation. And that stuff just doesn't work. So just the same way that if I asked you how you would react to someone pulling a gun on you and trying to carjack you, you probably wouldn't be able to actually assess your reaction to that situation because you've never been through it. So another reason why risk tolerance questionnaires are not good. They don't focus on your goals and they're not accurate. So that's my rant about risk tolerance questionnaires. But let's get into it. So we're going to go through a real world example of setting goals. So we'll do a little bit in the PowerPoint, then I will switch onto our website and show you a tool that you can use to help you set goals. This tool is also available in other places as well, and I can talk about that. But let's start with what a goal is. So anytime you are putting together an investment plan, you need to start with your goals. So whether you have a portfolio, you don't have a portfolio, and you're starting to invest, let's start with goals. Now, goals need to be very specific. So, and we'll show you why a little bit later, and this is a difficult exercise for people to go through, but there are 4 questions you need to ask with a goal. How much will your goal cost? So remember, we are investing to try to achieve a goal. So in the future, how much will this goal cost? And remember inflation. So particularly if this is a goal that is far out into the future, you are going to have to realize that the purchasing power of your money is going to be less in the future. So how much will your goal cost? When do you want to achieve your goal? So we obviously need to know the timeline of when you want to achieve it. How much have you saved for your goal? So hopefully that's pretty simple. Getting together some statements, looking at what you have. How much can you save in the future for your goal? So we need to answer these 4 questions. The one important caveat to put in here is these things can change and they will change over your lifetime. So don't act like you putting in a retirement goal from 30 years that nothing's going to change. Of course it's going to change, but going through this process of setting your goals provides really valuable inputs into your portfolio. So that's why we want to do it, knowing that circumstances do change. Our favorite attendee, the anonymous attendee, has put in a comment, which I like. I've been asked so many times about my risk tolerance, stupid bloody question. I agree. So thank you for saying that. And we'll get into why it's a problem. Other than my rant, we're going to go through some examples. All right, so let's move on. You come up with those 4 questions or answers to those 4. We're going to go through an example. All right, so here's our example. And we did this on our podcast as well. Our most popular ever podcast episode was on portfolio construction, where we walked through Shawnee's retirement, which was exciting for me because she's not retiring for 38 years, which is probably less exciting for her. Anyway, let's start getting through this. Oh, and speaking of retirement, so Lewis, who just joined our editorial team and is in the room, I went up to Noosa for the weekend before everything happened in Queensland that happened in Queensland. Lewis was telling me that his grandfather lives by Noosa and he retired at 57 and now he's like 97. So that is a good long retirement. That will not happen to Shawnee since she's working 38 years. But let's go through this example. So I want to retire in 20 years and take 70% of my current income of $100,000 out of my portfolio on an annual basis using a 4% withdrawal rate. So let's talk about some of these inputs here. Now, I said that we needed to define how much our goal was actually going to cost in the future. Now, that is difficult to do, particularly if you're looking at something like retirement. So in this example, we are instead focusing on income because income's a little easier for people to picture what their spending habit or what they can actually get out of that income. So it can be a little bit hypothetical to just talk about a certain portfolio value. So a lot of people start with income, and we can, of course, then just calculate that amount that we need for a portfolio value to support that level of income. And so we'll talk about a couple of these terms in a second. But first of all, we want to include inflation. So what we're doing in this example is, in this example, the person is making $100,000 a year. They think they can survive in retirement on 70% of that salary. So that's great, but we know that in 20 years, $70,000 a year is not going to be the same as it is now. So what we've assumed from an inflation rate perspective in this example is 2.2%. So that's going to give us $107,544 is what we need in 20 years to support that same lifestyle, assuming that inflation amount. So that's one important thing. The other important thing to calculate this figure is this 4% withdrawal rate. So on Sunday, I believe, when we release a week from Sunday, we'll have a Investing Compass, the podcast episode on this. 4% withdrawal rule is a pretty famous rule in investing. There's a financial planner that in the early 90s got asked by all of their clients over and over and over again, all of his clients over and over again, how to come up with a withdrawal rate that is safe to take out of your portfolio. So he came up with a 4% rule. So that basically means that going back, and the way he did this is he went back and he looked at historical market returns, I think from 1922 to the early 90s. So I think this was in 92 or 93. And he basically ran scenarios where he imagined somebody retired every year from that date. And what that gave him is different sequencing of returns. So basically he did something called a Monte Carlo simulation, I think in an easier way. So he came up with 4%. Now the 4% rule says that in every market scenario that he went back from the early 20s to the early 90s, that a 4% withdrawal rate meant that you would not die after you ran out of money, which is the whole point of retirement savings, right? Sort of this zero-sum game where you don't know when you're going to die, but you don't want to run out of money before that happens. Now, a couple very brief caveats. We did do this whole podcast episode on this. 4% withdrawal rate was looking at historical returns in very different market environments from right now. Namely, fixed income averaged 4 to 5% a year in between those two periods. That's not happening now. It's mathematically impossible, right? With rates where they are now. And also, I think I would be relatively nervous about equity returns going forward anyway. But 4% rule, that's a whole different episode. But that's what I used. So 4% comes up with a little south of $2.7 million in your portfolio. We know you've got 20 years. You've got $450,000 in your portfolio. And you've got an annual savings rate of $7,000. Now, why are we going through this exercise? We're going through this exercise because this allows us to calculate something called the required rate of return. And here we go. The required rate of return is simply getting you from where you are to where you want to be. So that is the return on your portfolio that you need to achieve your goal. So this is the whole point of investing, right? We are trying to get this required rate of return so that we achieve our goal. Now, what does this come out to? It comes out to 8.6%. And I'll show you how you do this in a second. I'll go to your website. But this informs all sorts of things around your portfolio. So this required rate of return, we know as investors, the more risk we take on, hopefully the more reward we get. In other words, if you want to take on no risk, and risk defined by volatility of your portfolio, if you want to take on no risk, you put all your money in the bank, and as we all know, you basically earn no return. So the further out you go on the risk spectrum in terms of assets, so if we move to fixed interest, then we move to equities, etc., further out we go on the risk spectrum, the higher rate of return we should get, the higher expected rate of return we should get over the long term. So in this case, instead of relying on that risk tolerance questionnaire where you say, I'm really risk adverse, and your advisor puts you into a portfolio filled with fixed interest, in this case, you're looking at the return you need to get in order to actually achieve your goal. So that should inform how much risk you take on as an investor. So we'll get into what this actually means a little bit in a second. We've got a question from VC. And the question is, how did you select a 2.2% year-on-year inflation? Okay, that is our estimate at Morningstar of what long-term inflation rates will be. Now, they've actually been a little bit higher in Australia, even if you go back and look at the last 10 years, but that's the rate that we use here at Morningstar, so that's why I picked 2.2%. What I would say about inflation is this is when you do need to think a little bit about your personal circumstances. We all have different levels of inflation. So obviously the official level by the government is a basket of goods. the basket of goods doesn't necessarily represent what each of us spend our money on. So think about that. So examples are if you owned your house outright. Well, your housing inflation, and you don't want to move, your housing inflation is a lot lower, right? So you don't have to worry about, number one, paying your mortgage, but you don't have to worry about trying to chase the property market to move into another house. If you are a renter like me, then you have to worry about your rent going up. Now, things have been good because my rent went down, and I think a lot of people's have right now, but obviously I know that that's not going to happen for, in this case, 20 years. So something to think about. All right, so let's quickly go. This is when I'm going to switch on to the other website, or the actual website. And I'll show you how you can calculate this required rate of return. So there's a lot of different ways that you can do this. Obviously, I like the way that we do it on our website because I wrote the requirements for it. But you can also do this through any sort of financial calculator. So if you literally just Google financial calculator, and I'll do that afterwards, show you guys how to do it. But I think we have a pretty good calculator on here. Okay, so what we want to do, so we have basically this goal setting scenario. So in Morningstar Premium, you can set and save goals, and I'll show you how that works in a second. But first, we want to calculate that required rate of return. So remember the inputs that we have. I don't remember the inputs we have, but hopefully you do. Okay, so $450,000. So that's what we want to put in. Remember, we already did that inflation calculation, which gets us basically to 2.7 million is what we want from a retirement perspective. Now, I've used inflation already because remember we did that calculation because we're going off of what your basically withdrawal requirements were. But you can also put in inflation. So if I put in 2.2%, 22%, that would be Argentina-style inflation. So what that's going to do is going to give you that inflated future value. Now, this is only over 1 year. So if we do 20, you can see the impact of inflation on that portfolio. But we've already taken that into account. But we do have that inflation rate that you can add in. So let me put that back to zero. Now remember, we're saving $7,000 a year. All right, not 70,000, 7,000. There we go, $7,000 a year for 20 years, 450K to 2.7 million. There you go, 8.6%. So that's going to automatically calculate that for you. Now, you'll see if I change this number, any number I change on here is, of course, going to change this amount. And if your required rate of return is a little too high, we put a little warning up there for you. Now, that's the other really good thing about the required rate of return. It can tell you if your goal is even feasible. So if you're getting a really high required rate of return, it means you're not going to achieve your goal unless you're Warren Buffett. So that's something. It can be a sense check on what your goals are. And of course, if it's really high, it means you can make adjustments, right? So if I go back, well, if I'll leave this in, 200,000 to 2.7 million. So now I can make changes to try to see what impact that will have. So if I could say up 20 years, I guess I could work a little longer. So if I'm like Shawnee and I want to work 38 more years, then that comes down to 5.9%. So that's how you can change assumptions. You can change your savings rate. I can go back to $70,000. I'll change this back to 20. Now it's 4.6%. I can change that future value. So you can go through and change all those different inputs. And that's how you can decide if that goal is feasible. And what that allows you to do as an investor is it allows you to control the things you can control. Of course, we want to try to control that required rate of return or the return we get by taking on an appropriate amount of risk. But we can also control other things like how much money we save. When we actually want to achieve your goals, delaying that, raising the money you save, all of that will, of course, raise the future value that you have. In this case, because the future value is set, it'll lower that required rate of return. All right, so we're getting some questions. Let's try to answer a couple questions. Okay, yeah, so Grant has a question that I think I just answered, but we'll see. He says, I guess you can fine-tune the other assumptions which may reduce risk and required rate of return, increase savings in the earlier years. Exactly, Grant. So that's the exercise we just went through. And what that allows us to do is make informed decisions. I've seen a lot of Okay, I won't go on a full rant about this. And I don't think I rant about things. I just get that feedback about it. I've just seen a lot of personal finance related content that has come out, particularly generated towards younger, less experienced investors, that's really focused on, great things, savings, investing, and everything else. But a lot of the assumptions that go into this, I think, are pretty off. And so that's why it's important to go through and look at some of this stuff yourself. So you're right, Grant. You can control what you want to control, your savings, going out and trying to earn extra income. There's all sorts of things you can do to change this. Okay, so good comment from Dallas. So saying, could you do a separate session to help older investors who have not had the opportunity to get this level of savings, which allows for having to deal with Centerlink and set government reduction from investments? Yeah, we can talk about that as well. All right, so we've got a question from Vanessa. So Vanessa goes, how do you access this section of Morningstar? Is it a membership-only area? So it is, but you can take out a 4-week free trial, Vanessa. And if you want help in doing that, you can email me at mark.lamonica1@morningstar.com. So you can do that, and I'll show you a different way you can do this as well. What's a reasonable rate of return range? That's a really, really good question from Madonna. Listen, it's tricky to say. I would say right now, given where valuation levels are, and given the fact that you're getting nothing from fixed interest, I would be very wary as you even creep up into the high single digits of returns, particularly from where we are now. I would be concerned about that. Now, if we go back and historically look at returns, so the ASX has returned something like 9% since 1900. But yeah, I would just be very careful, given where we are from a valuation perspective on equities, and certainly fixed interest. You're just not getting much of a return. But that, of course, is impossible to answer because it is the future. But being conservative is not a bad thing. If the markets return more than you assume, guess what? You just have more money. Which is nice. Okay, we've got a question from VC. How do we select equities ETFs that can give us 7% plus returns? We'll get to security selection in a second. Let me show one more thing. I'm going to go back to the old internets. All right. So this is obviously what we've designed on Morningstar Premium, but I will. So if you Google financial calculator, I can send you the link to this. Okay, I don't want to buy one. You can buy one and do it. All right, so if you go to this calculator.net, you can do the same thing. Now, in my opinion, once again, as a person who designed the tool I just showed, I think ours is better. But what you can do is you can calculate the same amount. So this IY is the interest rate, which is also the rate of return. Now, if we want to do this same thing, number of periods, 20. Now remember, the number of periods in this, and this is why it's a little more complicated, the number of periods will correspond with what your savings is based on. So if you put in annual savings, that should be 20. If you're putting in monthly savings into this, and remember there is a compounding effect from investing monthly. I was being a little conservative there at that 7,000. You would want to multiply, of course, those periods by 12 in that case, 4 if you're doing quarterly, et cetera. Present value, that's how much you have now, so that would be 450. Periodic payments. Now, they're negative in here just because of the way financial calculators work. So you keep it negative, you put in 7,000. Future value, that is at $2.7 million. It will come up with what rate of return you need to meet that. So you can go do that there as well. I think our website's better, but I should think it's better. All right, let's keep going through this. I'm going to go back to the PowerPoint. All right, so we are going to now, so let's pretend we did this on March 31st, 2010. See up here in yellow. Now we're going to magically go forward 10 years into the future. Well, we went one day less than 10 years. I guess we screwed up the time machine. But anyway, it's yesterday, which was a better day because I was on leave on the beach. But anyway, now we're all back here. Okay, so we are going forward 10 years. Now, This is the other really good thing about calculating a required rate of return. It allows you to actually assess where you are with your portfolio. And particularly if you are investing for very long-term, long periods of time, one of the things that I think frustrates people is that it's very hard to see progress in your portfolio. And the reason it's very hard is because of how compounding works. So what that basically means is returns are not linear. So it means you are going to get you're going to see your portfolio grow very, very slowly in the beginning, and you may think you're off track, but you're not. It's the compounding over many, many years that actually makes the big difference, and you'll see from a dollar value, so linear in terms of dollar value, from a dollar value, you're going to get your biggest dollar returns towards the end while you're approaching your goal. So remember that. And that's why I like looking at a required rate of return as a way to track whether you are on track to achieve your goals. So let's look at how this works. All right, so you put all of your money into the Vanguard Australian Shares ETF, one of Laura's favorites, who's also in the room. There's a lot of people in the room. So you put all of your money into this Vanguard Australian Shares 10 years ago. So all of a sudden you look at your account, 10 years from now, it went up 7.58% a year in that 10-year period, which, is decent, right? So what has happened? Well, all of a sudden, your $450,000 portfolio has turned into $1.033 million, which is pretty good. That's exciting, right? So now you're a millionaire. You're still saving $7,000 a year. So you either are not making any more money or you're spending more on yourself, because now you're a millionaire and you can spend on whatever you want, which I guess is exciting. Laura would spend her money on gin, I suspect. So now you have 10 years until retirement, but you have no idea if you're on track or not on track, except for the fact that now you can go back and recalculate this required rate of return. And what do you come up with? You still have that $2.7 million goal, 9.6%. All right, so that's a problem. You are falling behind. So originally you needed 8.6%, now you need 9.6%. So that's really bad, right? So as an investor, you shouldn't be happy. But hopefully you've been doing this, not just once every 10 years, hopefully you've been doing this periodically over that time, and you've been adjusting things. So instead of Laura going out and buying more gin, she's going to save more money. So that could be something that she does, or she could delay her retirement. I don't know when Laura is going to retire because she was not on the podcast, but that's another option. So that's why you want to calculate your required rate of return, because, as I said before, it allows you to do something. So what could you do if you went to this 10-year period? And I'll show you on the website how we can do this for you as well. All right, you've got a couple different options now. Now, your option, oh, I didn't update the slide. Forget this April 1st thing. That can be my April Fool's Day joke. I'm covering it up with something, although you can still see it. So what does this allow you to do? It allows you to actually adjust what you're trying to do to still achieve your goal. So if you want to get back to that original required rate of return, you can do a couple things. You can increase savings to $22,840 a year. So that's a big increase from $7,000. So Laura would have to be buying a lot of gin to just be able to make up that savings by cutting down on her expenditures. So that's one option. The other option is you can delay your retirement by 14 months. So all of a sudden, you're retiring a little over a year later. And that's fine for Laura because her best mate, Shani, will still be working because she has 38 years to go. You can also invest more aggressively, okay? So you can go out further on that risk spectrum. Now, 9.6% is a lot. So I don't know what you're doing then. You're buying a SPAC or whatever other ridiculous investments are out there now that people are essentially gambling on. Or you can reduce your retirement goal by $350,000. So you can sit there and say, okay, I don't need this $2.7 million retirement. I don't know what, but I want to lower retirement. So you can lower that retirement goal as well. So those are all the different options you can take. And the thing that I like about this, of course, is because this is a real way that you can determine how you adjust your portfolio to still reach those goals. The problem that we run into a lot as investors is, yeah, you're seeing returns in your portfolio. You don't know if you're tracking against your goals. You don't necessarily know how to adjust. And what happens is one of two things. There are some people who save too much. And it is possible to have too much money compared to a goal. Some people save too much. Some people invest way too aggressively than what they need to. What happens to a lot of people is they invest way too conservatively, and they don't save enough to reach their goals. So what this allows you to do is make those adjustments. And once again, you can always change your goal. If you're doing really, really well, you can up that goal, that you want to have a retirement where you spend more money. That's what this whole process allows. So let me go back to the website. I told you I was going to switch around a lot. So I'm actually going to go to a different website. That other one, so I opened a couple different windows. All right. So as I said, what you can do is you can go and set your goals as I went through that process, and you can save them. Actually, sorry, we're switching around again. Let me just show you guys how. Here, this is where we are. So I set this goal. What it allows me to do is save this goal. So I can go in and say Laura's retirement, and then I can link it to a portfolio. So that's what it allows you to do is you can save that goal. So let's go back to the other website. Lots of switching. All right, so unfortunately, we did not have this goal calculator 10 years ago, but I do have an example of what you can do. So if I go to track investments, this is where your goals are saved. So if I go to that rate of return calculator, I've just thrown in a bunch of goals. So let's go and look at this retire early goal. Since everyone is sick of me, it would behoove me to retire early to make Laura and Shawnee's life easier. Lewis just started last week, so he has yet to start hating me, but I'm sure that will happen. Okay, so what I did is I went through and I just did another example. 760K, I want to get to 4.5 million, 19 years, 9.81% was that minimum required rate of return. Now that's high. So just remember that for the point of this example. So this goal I set up in November 2020. So some time has passed since then. Money has been added into this hypothetical portfolio. There's obviously been return. So I can now check automatically my current required rate of return. So it's automatically doing that calculation. And the reason it's doing that is because I have linked this to this portfolio. So it knows how my portfolio is doing. And what it's doing is it's just recalculating that number based on the performance of my portfolio, how much money I put into that portfolio. And none of my goals, of course, have changed. I still want the same amount of money. I still want it at the same date. It will obviously automatically adjust the date as we go forward. So in this case, this is good. So my required rate of return fell, which means I'm actually ahead of the game. So this is a very good thing. And this is just, once again, a tool that allows you to do the same thing that I was outlining in that PowerPoint in terms of calculating where we are from a portfolio perspective. All right, so we've got some questions. Why don't we take a break to answer some questions, and then we'll get into the last part is, how does this inform my asset allocation decisions? Then how can I actually find investments to reach that? So, oh, somebody said, I like how this is linked. Nice. I like it too. But once again, it was something that I wrote requirements for. All right. Okay, so we've got a couple questions. Okay, so we've got a question from Grant. So Grant says, is there an option in the calculator to enter the long-term average return, as this is what you should expect to earn, and then tweak the savings assumptions? There is. So let me show you how to do that. Grant, you are going to win Participant of the Day. I never won a lot of participation awards because I was lazy and had a bad attitude. But here we go. Going back to track investments. So we've got a rate of return calculator, which is what we looked at. We've also got this portfolio projection calculator. So basically what you're doing now is you are in control of that rate of return. So let me show you how this works. And this will allow, you can also do this in Excel using the what if function in Excel. But that's a little more complicated. But all right, so 450,000, and we wanted 2.7 million. Oh, that's the time horizon. Okay, not 2.7 million years, which people on my team tell me it seems like I've been alive that long. 20. We'll put in 20. I was wondering why that number didn't work. That would have been very embarrassing. All right, so we've got a starting value. Of course, we don't have a future value. We are saving annually. We are saving $7,000. Not 70 grand. There's something wrong with me. I keep putting in too many zeros. I have too few zeros in my bank account and too many zeros in this. All right, so what did we say? We said 8.6% roughly, right? All right, so that's giving us basically that same amount that I had rounded up before, close to $2.7 million. So what this will allow you to do, Grant, is you can just screw around with that rate of return. The other really cool thing that I think you get out of this rate of return is I can put in the inflation rate. So if I put in that same 2.2%, so what the inflation rate will do now is you're still getting the same amount of money in the future. But what the inflation rate's going to do is going to dial back the purchasing power of that money so that you can think about, in today's dollars, what do I get? So even though I'll sit there and be like, wow, I've got close to $3.5 million in 2041, in reality, if we have a 2.2% inflation rate, I only have the purchasing power of $2.2 million. What this calculator also allows you to do is come up with that original assumption. So remember what I said? I said 70%. What is wrong with me today? I put in $70,000, right? So that's what I said I wanted out of my portfolio. So this is before we, of course, use that 4% withdrawal rate. 20 years. Additional investment, in this case, we're going to go none. And what I can put in, and I'm going to put in 0 for the inflation rate, but if I put in the expected inflation rate of 2.2%, what that's going to do is that's basically going to show me the purchasing power of, sorry, I'm putting things in the wrong. Why does that keep coming back to 7,000? Does anyone know? I don't know. This is a bit of a struggle today. Anyway, now it worked. So I put in that 2.2% in the rate of return because I want to calculate the purchasing power of that $70,000 in the future, how much money I'll need to get that same purchasing power. That's that number we came up with, that $108,000. So anyway, hopefully that answered your question, Grant. But we will we'll get there. Okay, so we have a question from June. So June says, given we are in the pension and accumulation phase in our self-managed super fund, how can I use this tool to aid us when editing our investment strategy? Should have added that we are unable to add any further funds to our self-managed super fund. Okay, so what you can do is you can do a couple different things there. So of course, this is when you are trying to achieve a goal. So a goal like retirement. What if you're actually in retirement? Well, obviously you need to keep investing when you are in retirement. So one thing I would look at is, are there different phases of your retirement? Is there perhaps a time where you do want to continue spending more money? You can sort of go through this whole exercise saying, okay, and a lot of people, when they first retire, they're a lot more active. Except for in Lewis's grandfather's case, because he's in a 40-year retirement. But a lot of people will sit there and they'll say, I'm going to have a little bit of a phased retirement. So I'm going to travel a lot initially. So that might actually cost more. And then later on, what I'm going to do is I'm going to become less active, and I think my expenses will go down. So in a situation like that, you can literally chunk up your retirement, almost take like a bucket approach to different phases of your retirement, saying, okay, so when I enter this non-active phase of my retirement where I think potentially those expenses will go down, I can set that goal 10 years out in the future, saying, all right, in this case, in this $70,000 scenario, I think 10 years out in the future, maybe I want to spend $40,000 a year in retirement and figure out what is the lump sum in my portfolio that I'll need to support that. And then that allows you to look at what's left over and sort of plan out how you were going to spend that next phase of your life. So that's certainly a way that you can do that. The other thing that you can do is, of course, if there is to fund withdrawals, to fund whatever else you want to put into your portfolio, is there a way that you can come up with a required rate of return for that? Yeah, you can. So you can calculate that and then sort of track how you were doing as you go forward. All right, we were worried about you, Lisa. So Lisa went 40 minutes without asking a question, which is not good. So Lisa, of course, is our favorite alpaca. I don't know, you just have a couple alpaca. It seems like it's more of a hobby. But you are our favorite alpaca owner in New South Wales. So Lisa says, does the calculator assume variables such as your investments are compounding, or are they actively managed, or just based on math? Yeah, it assumes they're compounding. So it does assume all your investments are compounding here. And that, of course, is earning a return on your return. So that is built into the calculator. It does not assume anything, and we'll get into asset allocation and selecting investments. It, of course, does not assume anything about those investments, right? It doesn't care what you're invested in, whether you are in Bitcoin like Will, whether you invest in gin like Laura. It doesn't care what it is. It just cares about what that return is. Laura's giving me dirty looks now, so I don't know if she tucked into the gin early or what happened. But yeah, I went out for a couple of gins with Laura last Wednesday, and she had a lot cheaper dinner because after she took the train home, she went to McDonald's. So that's one way to save money. All right, so let's get into the last part of this, why you want to do this. So remember that your required rate of return is going to inform the asset allocation in your portfolio. So there have been numerous studies that have been done around asset allocation. Famous one, Ibbotson study, which was a guy who started a firm that Morningstar eventually purchased. That's Morningstar's investment management. Now he was a professor. The Ibbotson did a famous study where he said 90% of returns can, of course, be attributed to asset allocation decisions. So asset allocation decisions just mean what are you putting into your portfolio? So we talked about before, depending upon where you are on that risk spectrum, you have higher or lower expected returns. So that means that the mix of assets that you put in your portfolio is going to drive the overall expected returns that you're going to get in your portfolio over the long term. Now, remember, there can be a lot of volatility in the short term, but you're hoping over the long term that taking on more risk is going to result in a higher return. So that's how you actually decide upon your asset allocation. So I have seen all sorts of very strange approaches to decide on asset allocation. But once again, you want to take on as much risk as is necessary to achieve your goal. That's the whole point in investing. As we said at the beginning, you want to achieve your goal. You are saving money. You are putting it away and investing it so that you can buy something in the future. So asset allocation, We've got a tool for that. So we have asset allocation models built in here. So what these are is a series of 5 different models that have different risk and return profiles on them. So you see all of these are based on CPI. So if I go back, so CPI is inflation. So what this is taking is taking an inflation plus approach to investing. So CPI plus 4. So that means we're going to try to earn, with this asset allocation over the long term, 4% on top of inflation. So you can see what it's basically done is it is divided up this portfolio into different asset classes. So everything from equities to listed property to infrastructure to fixed interest to cash. Now, fixed interest, excuse me, and cash are, my voice just cracked. That's really embarrassing. I am like a teenager. Fixed interest and cash are defensive assets. So this is portfolio. You can see, obviously, by doing a little bit of math, get a calculator if you need to add 4 plus 3 plus 3. But that means 10% of this portfolio is defensive. 90% is in growth assets. Now, what your asset allocation decisions mean, it means that now you can start looking at investments. So this is that last step. And remember, we want this to be the last step. And I know this isn't fun when you're at the barbecue like me, by myself over Easter because my trip back up to Queensland will probably be canceled. So when you are hanging out at the barbecue, nobody wants to hear about your asset allocation because it's really uninteresting. And nobody wants to hear about your goals, frankly, unless your goal is really exciting. But they want to talk about investments. But now we can get into investments. So I can look at each one of these asset allocation buckets, and I can then go find investments to help me reach my goal for that asset allocation bucket. Now, we are developing, and it will be out hopefully in a week and a half, a new tool to help you make those decisions. Because as we had that question earlier, I don't remember your name, sorry, because Shani deleted the question. So, oh, okay. It's in the answered. I'm going to find your name to personalize this. VC asked this question. How do we actually select investments? So we are going to build this new tool, or we've already built it. I've seen it. Looks good. That actually walks you through the decision then, okay, for each one of these buckets, these asset allocation buckets, what do I invest in? Do I invest in direct equities? Do I use a managed investment like an ETF or a managed fund? If I'm using a managed fund or an ETF, should I use an active strategy, a passive strategy? Should I use should I use an exchange, a listed vehicle like an ETF, or should I use a fund? So we're building that tool to help you get through that. But in the meantime, if you go to our Learn to Invest section, we have the old tool of reading. So you can read the Morningstar Guide to Selecting Investments written by Shani, who made fun of my clothes today. But she still writes a great guide despite poor fashion choices. You can actually go through and read how you go through that process. And then what you can do is you can go on to Discover Investments and, of course, find investments depending upon those decisions that you've made. So, of course, we have stocks. We'll go to ETFs since everyone loves ETFs. So what you can do is then you can go through and find, based on that asset allocation, different ETFs that you might be interested in investing in. So if I need to fill my Aussie equity bucket and I know that I want to invest in an ETF, you can go through and see what our research teams think are the best ETFs. So the ones that receive a medalist rating. So we rate funds and ETFs, gold, silver, bronze, which mean that we think on a forward-looking basis, they will outperform their index over a full market cycle, so at least 3 years. You can go see which ETFs you might want to invest in. This is, of course, the Vanguard Australian Shares ETF, Laura's favorite ETF that we were talking about before. And you want to see if we go to performance. Remember when I went back and looked at 10 years? Well, that's where I got this 10-year return from that we used. Just to bring this thing full circle. So that's the last step, selecting investments. So once we have this new tool out there, I will do another webinar to show that off. Because once again, I think it's pretty good. But read Shani's guide. That will walk you through all of that information. All right. So we're out of questions. We still have 12 minutes left. So if anyone has any questions, let me know. One other thing, we will, of course, record this. We are recording this, even though Will forgot to press the special YouTube button until 5 or 6 minutes into this. You can access all of the recordings on Learn to Invest, Morningstar Investing Bootcamp. You can go through. The best part of all of our webinars is Will takes these screenshots where I am embarrassingly gesturing. So look at these. I mean, it is horrifying. So you can go back and watch those. You can also go to our YouTube channel. So Will's Pride and Joy. So just Google Morningstar Australia YouTube. And we've got those on YouTube. The picture quality will vary because Will didn't press that button. The first 10 minutes is going to be kind of fuzzy. This one will be good. Yeah, it will look like the first 10 minutes will look like the moon landing or something, where people can try to figure out if this event actually occurred. But after that, it will be better. Grant, once again, coming in at the end to solidify his hold on attendee of the day. We always give it to the anonymous attendee because I think it's funny when people attend these things anonymously. That's my boss. So Grant says, I use ETFs asset mix to inform my own direct investment mix. Yeah, so I think what Grant is saying is Grant is looking at an ETF. An ETF, of course, represents an index, so it's easy to see. Many ETFs represent indexes. There are also active ETFs, but you can go in and look at an ETF. Like if you want to look at, and we've done that a lot on these in the past, where we're looking at like a global index to see, hey, what is the different mix of assets? So whether that's countries, whether that's, and we did this one in the international investing one where, Australia makes up something like 2.2% of global developed market indexes. So it sort of shows if you have 90% of your money in Australian shares, you're making a big bet on Australia, which frankly has paid off well in the past, but we'll see in the future. So yeah, ETFs are a good way to also look at overall indexes and what are the different parts that go in there. All right, so unless somebody asks 4 questions in the next 10 minutes, Grant will win attendee of the day. So I don't think that's going to happen. So congratulations, Grant. If anyone has any questions, you can email me at mark.lamonica1@morningstar.com, and then look out for this video once Will pulls it together. So another question. Also, please check out the podcast. So the podcast, I really liked the portfolio construction podcast because we use a real example. So I did make up the one that we went through today. All the numbers are real, all the math works, but we use Shani as an example, and we actually walked all the way through using her own personal circumstances to actually go through and select specific investments. So we went through the rest of that process. So it's called, I believe, How to Construct a Portfolio on Investing Compass, Australia's hottest investing podcast. But yeah. Anyway, we've got a couple questions as I was talking about that. So Dallas's second question. Oh, now we have lots of questions. Okay, so looks like Will, you did not get your 10 minutes back. All right. So Dallas says, if you're in retirement stage and not looking for much drawdown, what is the problem with basically not worrying about the asset value and maximizing an income? Okay, so I think what you were saying, Dallas, is you are just taking income out of your portfolio. You are not actually pulling out principal. So I would say it means that you are in a very good position. So that's sort of the dream, right, of having passive income support our lives. So if you are in that situation, I would look at then diversifying. If you're just taking income out, how you're diversifying those sources of income. Because remember, that could be a driver as well. So you certainly don't want to put too much into a particular asset class. In this case, maybe if you're just talking equities and dividends, think about how your exposure across different sectors is, because different sectors will be impacted by different things that happen in the economy and how that could impact your income. So that's what I would look at. Personally, but yeah, you are certainly in a better situation where if you're not taking principal out of your portfolio, that means that volatility doesn't really bother you, right? You care about volatility in income, and we do see volatility in income. Dividends are, of course, not guaranteed, as we all learned in 2020. But you're more concerned about that volatility of income versus volatility of your portfolio value. Wow, we got a lot of questions. Okay, so Chris asks, how much time should you put into your strategy? Okay, well, the exciting thing about, I don't know if it's exciting, but the interesting thing about investing is sometimes putting a lot of time into it can lead to very, very bad outcomes. So people that spend all of their time, unless you're very disciplined, looking at the market, tend to overtrade. Which is a very bad thing. It's a bad thing because, number one, typically when people trade a lot, they're chasing hot investments. The other thing that happens, of course, is bad things like transaction costs and taxes. So I think if you're going to go look at this required rate of return approach, do not go look at this every day as the market fluctuates. Whether you are looking at this quarterly or annually, that's probably a good approach. From a rebalancing perspective, so of course, getting your asset allocation from where it gets to when you have different parts of your portfolio earning different levels of return back to what your long-term goal is. Yeah, don't rebalance too much because, of course, that is triggering all those bad events before, capital gains taxes, transactions, all the stuff I talked about before. That is, it's hard to say how much you want to put in, however much you are comfortable with, but yeah, just remember the danger of doing it too much. All right, so we've got a question saying, what mix of ETFs can provide a 9% return? All right, listen, if you want a 9% return, you definitely need to be in equities. Now, 9%, in my very humble opinion, is going to be hard to get from where we are right now going forward. That's my own opinion. A lot of people have different opinions, including most of the people on social media that I follow who come up with ridiculous numbers. But yeah, 9%, listen, 9% obviously historically has been what the ASX has returned. I'd be nervous about 9% going forward, number one, because interest rates, particularly interest rates dropping, are a big driver of equity returns, one that we don't necessarily give enough credit to. We're in a very low interest rate environment. These tailwinds that have happened literally since the mid-'80s of falling interest rates just cannot happen anymore. So I think that's going to put a potential damper on future equity returns, particularly when you think of the three parts of an equity return. There's dividends. There's, of course, earnings growth. So as the company earns more money. And then the third one is changes in valuation levels. I'd be worried that we are not going to get changes in valuation levels in a good way going forward. So as interest rates rise, as we've seen literally with some of the stuff that's happened, we all know how much Tesla has gone up. But go look at what Tesla has done recently. There's a lot of these high-flying stocks that have come down pretty significantly since sort of February, mid-February highs. And the reason is the market's starting to get nervous about interest rates going up and inflation. And as interest rates have crept up, all of a sudden, these very high valuation stocks, at least initially, have come back to earth because rising interest rates are going to lower valuation levels. So I'd be worried about that 9%, but you definitely need to be out on that growth spectrum. I would not have much defensive in there. All right. Okay, so here's a good question. Could you please, from the anonymous attendee, who knows what movie star this is asking this question that doesn't want to be known. Could you please define the variables F, P, I, and N in the formula you presented at the start of the session? Yeah, absolutely. So if we go back to this formula, we can look at, so I didn't spend much time on the formula because I found most people just like to use, calculators to do stuff. So F equals future value. The P equals the present value, so how much money you have now. Future value is how much you want. The I is interest rate or return, so the return you're going to get. And then the N is the number of years. So you want to do the same thing, basically. And those are fairly standard variables. On this finance calculator, it's basically the same thing. So future value, payments, how much you're putting in each year, present value, N is years, I over Y is interest rate, a year or a period. So those are the variables. All right, H.C. Lee says, 1997, 2005, 2008, and 2020, financial flops are regular and usually unanticipated. Most of us cannot duck in time. How should we factor in possible losses in planning the required rate of return for our retirement and when retired? Okay, so a couple different things I would look at. Number one, what I would say is we know there's going to be volatility. We also know, while they are usually unanticipated, and yes, going back and looking at stuff in hindsight does not count because everything seems obvious after it's happened. That's why we want to look at valuation levels and potentially dial down the risk. That's the other thing that I didn't show on here, that in many cases, I showed an example where we were falling behind from a required rate of return standpoint. Many people should be ahead, long-term investors, because returns have been so strong. So if your required rate of return is higher, is lower than what it originally was, it could be an opportunity to dial back risk. So that means moving in potentially cash. Now, it doesn't have to be permanent. It can be temporary, allow you to get through those things. Retirement, I'm running out of time, but yeah, be very careful sequencing of returns. So how returns are right before you retire and right as you retire. So when your portfolio goes from something gaining in value to when you're actually pulling money out, those returns are very, very important. Oh, somebody sent through a compliment, potentially. Yeah, I don't know. Maybe this is just a compliment. Well, thank you, John. He said, great wisdom about drawing down on income, not capital, from one so young. So young. You hear that, Shawnee? So young. And he said to smile. My teeth got knocked out when I was younger. I have fake ones now, so I don't smile a lot because I was very self-conscious. I got hit in the face with a baseball. My coach threw it. He was embarrassed. I was embarrassed. All right, we're out of time. There are a couple more questions. If you could just send me an email, so mark.lamonica1@morningstar.com. We're off on Thursday so that I can go on what will soon be my canceled trip to Outback Queensland. But I'll be back on Tuesday after a relaxing weekend of sitting at home by myself. So thank you guys for joining, and I'll see you Tuesday.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.